This book is directed toward investors and creditors who hold, purchase, or sell all types of securities and evidences of indebtedness, and who are aggressive because within their own contexts they expect a well above average return over the long term. For these investors, this book presents conservative methods of investment, especially equity investment, that the authors believe minimize risk for securities holders. It is our thesis that minimizing risk does not reduce profit potentials for investors in common stocks. Rather, minimizing the downside tends to enhance the realistic upside potential, especially for non-control investors in common stocks. Since many of the investors and creditors to whom this book is directed are financial institutions, for example, commercial banks, insurance companies, and investment companies, it ought to be useful to those interested in what U.S. financial institutions as asset managers do and why they do what they do. Some participants in this investment processes are outside, passive investors. Others are activists. Outside investors are members of the public and are distinguishable from others in three respects. First, individually, they have no control or influence over the businesses whose securities they hold or contemplate holding. Second, they do not have access to information other than that which is generally available to the public. Third, they are those whom the U.S. securities laws and regulations have been designed to protect. Throughout the book, we refer to them as outside investors and passivists, as well as non-control and unaffiliated security holders. The key is that they are active in management and not connected with the company issuing securities in any way other than as security holders. Non-control investors are also supposed to be the beneficiaries of various state laws and regulations, including blue sky statutes governing terms and conditions under which new issues may be offered. Anti-takeover statutes, statutes aimed at controlling going private transactions, more generalized common law and state statutory requirements covering the fiduciary obligations of those in control of corporations to unaffiliated common stockholders, and statutes defining appraisal remedies when stockholders dissent from force-out mergers or similar force-out transactions. Outside investors are additionally protected by rules promulgated by quasi-public bodies, particularly the New York Stock Exchange, among other exchanges, and the National Association of Securities Dealers.